The U.S. housing market looks active. Prices are still near record highs, and demand hasn't disappeared. But something strange is happening beneath the surface. Despite those high prices, far fewer homes are being sold. Inventory remains historically tight, and millions of homeowners who could sell simply aren't. That's not how a normal market behaves. When prices rise, supply is supposed to follow. More listings, more movement, more turnover. But this time, it didn't happen. So if demand is still there and prices are still high, why has the housing market stopped moving? A housing market that looks alive but isn't. The answer starts with a basic misunderstanding of how today's housing market actually works. Normally, high prices do what prices are designed to do. They bring sellers out. They encourage people to move, trade up, trade down, or relocate. That mechanism has broken. Over the past few years, home prices surged while transaction volume collapsed. Existing home sales fell sharply compared to pre-2020 levels, even as affordability deteriorated and demand stayed surprisingly resilient. That combination shouldn't last, yet it has. The reason isn't emotional, it isn't political, and it isn't because Americans suddenly decided they never want to move again. It's structural. To understand why, you have to stop thinking about housing as just shelter and start thinking about it as a financial contract. Because for most homeowners in the United States, the most valuable thing they own isn't the house itself, it's the mortgage attached to it. Over the last decade, tens of millions of Americans locked in 30-year fixed-rate mortgages at historically low interest rates. Rates that no longer exist. Rates the market cannot recreate today. For those homeowners, selling a house doesn't just mean giving up a property. It means giving up a deal. A deal that in many cases cuts their monthly payment in half compared to what buying the same home would cost at today's interest rates. That changes behavior. When homeowners consider moving, they're no longer comparing neighborhoods, school districts, or square footage. They're comparing interest rates. And in that comparison, staying almost always wins. This is what economists call the lock-in effect. But that phrase doesn't fully capture what's happening. This isn't people waiting for better prices. It isn't sellers being stubborn. It's a market where selling has become financially irrational for a large share of participants. As a result, homes aren't cycling through the market the way they used to. Turnover is down, mobility is down, and supply isn't responding to demand. The housing market isn't frozen because no one wants to buy. It's frozen because too many people can't afford to sell. And that creates a very different kind of housing problem, one that doesn't require a crash to cause damage. In the next chapter, we'll look at why the 30-year mortgage became so central to the U.S. system in the first place, and how a policy designed to stabilize housing ended up locking the market in place. How the 30-year mortgage quietly locked the market in place. To understand why today's housing market feels stuck, we need to look backward, not at prices, not at zoning, but at a financial product that quietly shaped everything: the 30-year fixed-rate mortgage. The 30-year mortgage wasn't designed to maximize affordability. It was designed to create stability. After the Great Depression, the U.S. government needed a way to rebuild confidence in housing. Short-term loans, balloon payments, and frequent refinancing had made home ownership fragile. So policymakers introduced a long-term, fixed-rate mortgage that protected borrowers from rate volatility and gave households predictable payments for decades. And for a long time, it worked. The 30-year mortgage helped normalize home ownership, reduced default risk, and made housing a reliable store of value for the middle class. It became the backbone of the American housing system, so successful that most people stopped questioning it. But stability has a hidden cost. When interest rates fall, the 30-year mortgage doesn't just make housing cheaper, it permanently reshapes incentives. Between 2020 and 2022, millions of Americans refinanced or bought homes at interest rates near historic lows, in many cases rates below 3%. These weren't temporary discounts, they were contracts locked in for 3 decades. That matters because mortgages aren't portable. If you sell your home, you don't take your interest rate with you, you give it up. And replacing it today means stepping into a market with rates 2 to 3 times higher. Even if the home price is similar, the monthly payment often isn't. This is where the lock-in effect becomes more than a theory. A homeowner with a 3% mortgage doesn't need prices to fall to feel stuck. They just need rates to stay high. Selling would mean resetting their entire financial structure, higher payments, less flexibility, and often a lower standard of living for the same house. So they stay. Multiply that decision across tens of millions of households, and you get a housing market that looks active on paper but barely moves in reality. Listings stay low, turnover collapses, and supply stops responding to demand. This is why rising prices haven't triggered the normal wave of selling. The mechanism is broken. And here's the critical part most discussions miss. This isn't cyclical behavior, it's structural. The longer rates remain elevated, the stronger the lock-in becomes. Every month homeowners stay put reinforces the shortage. And even if rates come down slightly, many owners still won't move, because lower doesn't mean low enough. In other words, the housing market isn't waiting for a crash, it's waiting for a rate environment that may not return. That's why proposals like longer-term mortgages, 40-year or even 50-year loans keep resurfacing. Not because they solve the supply problem, but because they mask it by stretching payments instead of fixing mobility. And once a market starts solving affordability by lengthening debt rather than increasing supply, it signals something deeper. Housing has stopped functioning as a market and started behaving like a locked system. In the next chapter, we'll look at how this lock-in effect shows up on the ground, which cities are feeling it the most, where inventory is truly frozen, and why some markets are cracking while others remain artificially tight.
The market split, where housing is frozen and where it's cracking. One of the most confusing things about today's housing market is that both sides appear to be true at the same time. Some cities are seeing prices fall. Others are hitting new highs. And nationally, the numbers look stable enough to suggest nothing is really wrong. But that surface-level view hides a sharp split underneath. Because the lock-in effect doesn't hit every market equally. It creates winners, losers, and pressure points, depending on where inventory, migration, and affordability collide. Let's start with the frozen markets. In many high-cost, high-equity cities, homeowners are sitting on 2 advantages at once: large price gains and ultra-low mortgage rates. These are places where people bought early, refinanced aggressively, and now hold mortgages that are impossible to replace. In these markets, listings remain extremely tight, not because demand is weak, but because sellers have no incentive to move. Even when prices are high, inventory stays low. Homes sell quickly, but very few ever hit the market in the first place. This is why cities like San Diego continued to post strong year-over-year price gains, even as affordability worsens. Why Las Vegas rebounded, with prices rising again despite higher rates, and why certain metro areas are still seeing appreciation above 15 or even 20%, not because demand exploded, but because supply never returned. The market looks competitive because it is artificially constrained.
Now, contrast that with the markets that are cracking. States like Florida and Texas saw massive inflows during the pandemic. Builders responded aggressively, construction surged, inventory expanded. But here's the problem. Many of those new homes came online just as affordability collapsed. As Business Insider reported, these states built more housing than almost anywhere else in the country, and now they're paying the price for overshooting demand. Rising insurance costs, higher property taxes, and elevated interest rates have changed the math for buyers. As a result, some of the fastest-growing pandemic markets are now seeing the sharpest pullbacks. Realtor.com data shows that Miami is down over 11% year over year. Denver has fallen more than 6%, Seattle over 5%. Kansas City, Oklahoma City, and San Jose are all posting notable declines as well. Even Manhattan, a market known for chronic undersupply, has seen average sales prices fall roughly 3%, driven by a surge in inventory. With nearly 10 months of supply on the market, Manhattan has officially crossed into buyer's market territory. That's not a crash, but it is a signal.
The key takeaway isn't that prices are falling everywhere. It's that prices are responding only where supply is allowed to move. In locked-in markets, supply stays frozen no matter how high prices go. In overbuilt markets, prices adjust quickly once demand softens. This divergence is exactly what you would expect from a system distorted by fixed-rate debt, and it explains why national averages are so misleading. When analysts say home prices are still up 6% year over year, they're averaging together markets that are frozen solid with markets that are actively deflating. Those are two completely different realities. What we're seeing isn't a single housing market. It's a patchwork of local systems reacting differently to the same structural constraint. And this is where the long-term risk starts to emerge. Because a market that can't rebalance through normal selling behavior doesn't correct smoothly. Pressure builds unevenly. Affordability gaps widen, and younger buyers are forced to chase the few available listings at ever higher prices, while existing owners sit still. In the next chapter, we'll look at how this distortion shows up in a less obvious way, not through prices falling, but through homes quietly getting smaller, and why housing shrinkflation is becoming one of the market's most underreported signals. Housing shrinkflation. Prices didn't fall, homes did. When most people think about housing affordability, they focus on prices. Did home values go up or down? Are mortgages more expensive or cheaper? But in this cycle, the adjustment isn't showing up where people expect. Instead of prices collapsing, the product itself is changing. This is where the idea of housing shrinkflation comes in. In consumer goods, shrinkflation happens when a product gets smaller, cheaper to make, but is sold at the same price. The label stays the same, but the value quietly erodes. The same thing is now happening in housing. For decades, the average size of American homes increased steadily. In the 1970s, the typical household had about 3 people living in roughly 1,650 square feet. Over time, household size declined, but homes kept getting bigger. By the 2000s, larger floor plans became the norm, even as fewer people lived in them. This expansion masked price growth. Even when price per square foot stayed relatively stable, total home prices rose simply because buyers were purchasing more space. But that trend has started to reverse. As construction costs rose and buyer affordability collapsed, builders didn't slash prices. They adjusted the product. New single-family homes have shrunk to their smallest average size in more than a decade. Builders are increasingly focused on smaller floor plans, fewer bedrooms, and tighter layouts, especially at the entry level. Zillow data shows a noticeable increase in new single-family homes with fewer than 3 bedrooms. In some markets, builders are offering detached homes that are hundreds of square feet smaller and priced $50,000 to $75,000 below traditional builds. This isn't generosity. It's survival. Builders can't lower prices without destroying margins. Land costs, Labor, materials, and financing remain elevated. So instead, they reduce square footage. The price stays high. The home gets smaller. From the buyer's perspective, affordability appears to improve. Monthly payments drop slightly. Sticker shock softens. But the trade-off is subtle and permanent. Buyers are paying similar prices for less space, fewer rooms, and reduced flexibility, all while property taxes, insurance, and maintenance costs continue to rise. This is why shrinkflation is such a powerful signal. It tells you that the market is under pressure, even when headline prices don't fall. It shows that demand still exists, but only at a lower quality threshold. And unlike price cuts, shrinkflation doesn't show up clearly in national data. Median prices may hold steady. Price per square foot may even increase, but the actual living experience is being compressed. What's more, this shift reveals something deeper about today's housing system. The market isn't trying to make housing cheaper. It's trying to make housing fit within a broken affordability framework. Instead of solving the supply problem, the system is shrinking the definition of what buyers are expected to accept. Smaller bedrooms replace formal dining rooms. Open floor plans substitute for extra square footage. Storage disappears. Flexibility vanishes. And over time, this changes expectations. Younger buyers grow accustomed to less space at higher prices. Builders normalize tighter designs, and affordability appears to improve without ever addressing the structural forces that caused the problem in the first place. Shrinkflation doesn't end housing cycles, it delays them. And it does so quietly, without triggering the alarm bells that price crashes usually set off. In the next chapter, we'll zoom out even further and look at the long-term consequences of this system. Why reduced mobility, compressed living space, and extended debt aren't temporary distortions, but signs of a housing market that's evolving in a much more constrained direction.
The real cost of a locked housing market. At first, a locked housing market doesn't look dangerous. Prices haven't crashed. Foreclosures remain low, most homeowners seem stable. But the damage isn't showing up in prices. It's showing up in how the economy moves, or more accurately, how it doesn't. The first cost is mobility. For decades, housing supported labor movement. People relocated for better jobs, higher wages, or new opportunities. Selling a home and buying another was expensive but manageable. That system no longer works. Giving up a 3% mortgage to take on a 7% one isn't just inconvenient, it's a permanent pay cut. Even meaningful career upgrades often fail to offset the housing cost increase. So people stay. Workers turn down relocations, employers struggle to move talent, regional labor shortages persist even when jobs exist elsewhere. The housing market isn't just locking homes in place, it's locking people in place. The second cost is misallocation of housing. Large homes are increasingly occupied by fewer people, not by preference, but by financial constraint. Empty nesters remain in 4-bedroom houses because downsizing would raise their monthly costs. At the same time, growing families compete over limited inventory, often settling for smaller homes or less suitable locations. The problem isn't just lack of supply, it's that existing supply can't circulate.
Housing stops behaving like a fluid market and starts acting like a fixed grid. The third cost is inequality acceleration. Homeowners who bought before rates rose are insulated. They benefit from low payments and rising equity with minimal risk. New buyers face the opposite reality: higher prices, higher rates, smaller homes, and far less flexibility. Renting becomes long-term, not strategic. Over time, housing wealth becomes less about participation and more about timing. But the most overlooked cost is hidden risk. Low transaction volume weakens price discovery.
Markets look stable because very few homes are trading. Stability becomes an illusion created by inactivity. Pressure doesn't disappear, it accumulates. When selling finally happens, it's more likely to be forced, driven by job loss, divorce, or financial stress. And forced selling doesn't unwind smoothly. It hits specific regions hard, all at once. This doesn't guarantee a nationwide crash. It guarantees fragility. A market that depends on people not moving in order to remain stable isn't healthy. It's rigid. And rigid systems don't bend. They eventually break. In the final chapter, we'll answer the most important question of this entire cycle. If housing is locked in place, what actually unlocks it and what won't? What actually unlocks the housing market? At this point, the picture is clear. The housing market isn't broken because demand disappeared. It isn't frozen because people can't afford homes at all. It's locked because the cost of moving has become too high. So the real question isn't whether housing will crash. The real question is, what actually unlocks a market like this? Many people assume the answer is simple: lower interest rates. But rate cuts alone don't solve the problem. Even if mortgage rates fall from 7% to 6% or even 5.5%, most locked-in homeowners are still sitting on 3% loans. The gap remains enormous. A modest rate decline helps first-time buyers at the margin, but it doesn't suddenly convince millions of homeowners to give up historically low mortgages. Lower rates may increase demand. They don't automatically increase supply. That's why rate cuts, by themselves, often reignite competition rather than restore balance. Another common assumption is that prices will fall enough to unlock the market. But prices don't need to collapse for the market to function, and waiting for a crash misunderstands how this cycle works. As long as homeowners remain financially stable, there's little incentive to sell at a loss. Forced selling doesn't emerge from price levels alone. It comes from income shocks. Which brings us to the uncomfortable truth. Historically, housing markets unlock through stress, not relief. Job losses, recessions, household income disruptions. These events force movement where financial incentives fail. This doesn't mean a housing crash is inevitable. It means that without stress, volume stays low and mobility stays constrained. There is another path, but it's slow. Time. As years pass, life events accumulate. Families grow. Retirements happen. Health changes. Estates settle. Divorce and relocation eventually break even the strongest financial lock-ins. Over a long enough horizon, housing always turns over. But this is a multi-year adjustment, not a rapid reset. New construction can help, but only at the margins. Builders can add supply, especially at smaller sizes and higher densities, but construction alone can't replace the volume lost from frozen resale markets. The existing housing stock is simply too large and too locked for new builds to solve the problem quickly. So where does that leave us?
It means the housing market is entering a new phase, one defined not by volatility, but by friction. Transactions stay low, mobility stays weak, affordability improves slowly, unevenly, and mostly through compromises: smaller homes, longer commutes, higher debt burdens. This isn't a temporary distortion, it's a structural shift. And the biggest mistake is assuming the market will behave the way it did in past cycles. This cycle isn't about excess leverage. It isn't about reckless lending. It's about a system designed around long-term fixed debt colliding with a sudden rate shock. The 30-year mortgage didn't break the housing market. It froze it. And frozen markets don't resolve themselves through headlines or hope. They thaw gradually through time, pressure, and adaptation. Understanding that is the key to navigating what comes next. If you found this analysis useful, consider subscribing to the channel. This channel focuses on the U.S. housing market not through headlines or hype, but through structure, incentives, and long-term data.
If you want to understand why the market behaves the way it does, not just what prices are doing, you'll want to stay with this series. In the next videos, we'll go deeper into how housing connects to labor mobility, interest rate policy, and generational wealth, and why this cycle looks fundamentally different from 2008. If you have questions, disagreements, or perspectives from your own city, leave a comment below. Thoughtful discussion helps sharpen the analysis, and I do read them. Thanks for watching. I'll see you in the next one.